Welcome to TheoTrade. This is Don Kaufman. Here we are. It is June 12th, 2017. Well, to kick off this evening, once again, in similar fashion to what we saw on Friday, traders were coming in and really attacking not only the Nasdaq, and that's what we're looking at over here. This happens to be an intraday, 1 day, 1 minute on the Nasdaq futures. And you can see the Nasdaq futures just getting hammered into the cash open today and bounced off of it. However, where did we really end up on the trading day? Just north of 5,700 on the Nasdaq futures. Very, very close to the opening print over there. But again, down about 0.6%. Nothing too insane. There did look like at a point today this was going to get a little bit more wild. Again, some good trading ranges though for those of you that are trading on an intraday basis. But I say much of the same. Well, specifically, Apple, it had a downgrade and once again was attacked heavily at the cash open. It rebound, but we're still down about 2.5% specific to Apple. And again, there was a firm that actually put a sell signal on it, which really sparked a lot of the sell side activity specific to Apple. What was fairly astounding though is when you started looking at intraday trade in a few of these underlying, specifically Google was one of the most wild moves on the trading day. And this is actually a print down to 936 all the way back to 961. But, this is all ancient history at this point. Listen, the market's closed. What you really want to focus on is moving forward. Again, one interesting thing today, and I see much of the same as Friday, we're attacking the Nasdaq, we're leaving the S&Ps alone, right? The S&Ps are largely unchanged. But an area that did not perform well today happened to be, of course, the XLF. If you recall in the weekend video, I was just making a very simple comment about the XLF. And, you have to look at the financials for what they are. I mean, that's the XLF, right? It's the financials. Look at them for what they are. And what kind of a marketplace are we in when the financials, okay, are the lifeboat? Again, when you're jumping into the lifeboat out there, do you really want the lifeboat to be the financials? And I want to point out, exactly this thought. When you look at, the 4-day expiration inside of the financials, okay, it's sitting on a fairly heavy implied volatility of 22.37%. You got to remember, there's also an FOMC meeting coming out on Wednesday. There's a lot of information obviously coming out this week, but the FOMC meeting, and everybody expects a rate increase. It's over 90% probability of a rate increase over here, but that's neither here nor there. Okay, there could be something else in the statement. Anyway, when you think about the XLF as your life raft, I don't know about you, but I would take my chances in the open ocean before diving into a life raft with again, the powers that be inside of the financials over there. And again, it's a little disconcerting that they have 50 cents of expected move left this week. I mean, that takes this product drastically higher or lower on a percentage basis. But I wanted to show specifically how the XLF did not perform nearly as well today. And you have to start to wonder, all right, so hey, maybe in the next day or two we get a little bit of bounce in the Nasdaq, but thereafter, okay, are they going to just start hitting the S&Ps because the XLF may not be there, okay, to support the S&Ps? And it's a very simple idea. If the XLF starts to sell off, okay, there's no question the S&Ps are going to head with it. Today, the S&Ps finished largely unchanged. An interesting and positive area on the day happened to be the XLE, which was energy. Energy came ripping up on Friday again, and today followed suit. Definitely off its highs, but nevertheless, energy was up almost 0.7% on a percentage basis. That really carried a lot of positive order flow to the S&P 500. But once again, you do that big timeout and you go, wow, when this is supporting a marketplace, you have to really wonder, is that a good life raft? Do you really want to dive in to the energy sector as your life raft after seeing it, pretty much year to date get slaughtered year to date? Again, this is a move from 78 all the way down to that almost 64 handle. Anyway, so that's neither here nor there. I want to know where opportunity lies. And for me, the opportunity in the trade that I'd be looking for, I think it lies within the Russell. Because again, you take a look at the S&Ps Okay, and I'll bring up the S&P futures once again here really quickly. And the S&Ps, they're just a day off of their their all-time high. Okay, but the Russell is as well. And the Russell has had even more of a breakout to the upside. Again, we're only 1 day removed from the all-time high print inside of the Russell. So you see some sell-side activity, grip hold in the Nasdaq, and everybody's, they got the fear going in the Nasdaq, and they're all looking at the Nasdaq, but you're not thinking about where the opportunity therein lies. Because if the Nasdaq's getting beaten up, that's all well and good. But do you really want to, jump in and try to short the Nasdaq when it's already been beaten up? And for me, again, I look at the Nasdaq over here. For me, I'm not going to short into this mess. I'm already short some Nasdaq futures, neither here nor there, but I'm not going to short into this mess. However, inside of the Russell, well, that's a little bit of a different story. So you have to ask yourself, if you believe that the sell side activity will proliferate this week, and that just simply means, listen, is it going to spread? If the Nasdaq catches a cold, is the Russell going to come out, heaving its guts and head on down? And if it is, there's a some fairly straightforward and very, very risk averse positions that you might want to consider. One of those happens to be in the IWM. Now, the IWM is just an easier, softer, gentler version, if you will, than the Russell. And I put on a few contracts at this position today, and you can see there's been some decent volume trading in here, but all I'm doing in this case is I'm looking for an in-out spread. Okay, now an in-out spread, I'm just buying the 142.50 and I'm selling the 140.50 for right around $1. Now I filled this earlier today. I filled a couple contracts at 96 cents. I filled a couple contracts at 97 cents. Right now it's trading for right around $1. So your maximum sustainable risk, okay, is about $1. Hey, look, I just filled another one right there. I've been buying them throughout the course of the day. And by the way, that was a literal fill. The IWM is open 15 minutes after the close. So you can see I just filled another one at 97 cents. So how ironic. You guys want to do another one? Come on, let's do another one while we're on over here. See if I can't fill another one over there. I'm working. I'm not filling. So we'll see if they fill me here momentarily on this last one. There's still a few minutes to go. So I go out there, and again, let me create a duplicate order so we have the trade up there that we're talking about. It'll duplicate the order, and I'm working that thing at about 97 cents. But if you buy this thing for anything under $1, all you're looking to do is get out of this trade with between about a 50, maybe 60%, in terms of what you're trying to profit. Specifically, I use about a 55% gain as my exit. And you're like, well, why would you want to risk $1 to make a 55% gain? Yep, there it is. I filled another one here on the SIBO at 97 cents. Okay. And that, by the way, I work orders like this all throughout the course of the day. I just, one lot over here. Why? Okay. That's good. That's how you should fill orders. So come in here and even work one over at 96 cents. Okay. So as I move forward with this, and again, you can see a bunch of contracts are filling right here, right now. As you work this order and you're thinking about the exit for the trade, I'm going to come over here and just, again, create a duplicate order, put it right to $1. So after you're in the trade, eventually want to get out of it. And you're, why would I want to make a 55 percent gain and risk $1? And the answer therein lies under what's called probability of touching. So first of all, your risk is defined. Now you have about an 85% chance of touching the 140.50. Now this doesn't mean that you have an 85% chance of making money. But when you start looking at look at the probability of even coming all the way down to 138.50, there's almost a 62% chance. And that, okay, undoubtedly would get you out of your spread for a 55% gain. So even though people look at the trade and they think, why would I want to risk $1 to be able to make roughly 55 cents? Well, the answer lies in the probability of you making the 55 cents, or the probability of you making the 55% is drastically higher than the probability of you losing the full $1. We have, 25 days unto which to either exit the trade profitably or you're going to start to take heat. obviously you have about $1 of risk in that position. And I think that this kind of defined risk trading, it's, everybody wants to hit a home run. But you got to realize sooner or later, that home run is going to hit you. If you're looking at a marketplace and you want to get out there and you want to get involved in the marketplace, but you don't want to substantiate too much risk, look towards these in-out spreads. And we have done, a tremendous number of classes here at TheoTrade specific to the in-out spread. And we're going to be doing an open house tomorrow. Again, tomorrow there's an open house here at TheoTrade. Even if you're not a TheoTrade member, you just go in there. And again, when I say go in there, it's just TheoTrade.com/open. Many of you guys have been emailed about it. TheoTrade.com/open. Register for it. We'll talk a little bit about the in-out spreads in considerably more depth tomorrow. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.